Alright everyone, this is a bit of a bonus segment. I'm really big on social proof. I guess you could say I'm like people who say they're from Missouri, the show me state. I like to see what people tell me, put into action to see if what they say is realistic. So, previously, we spoke about how creating a diversified portfolio can minimize the fluctuations in your account over time and help you realize the types of gains you want to get. So what I did was put together a diversified portfolio from various sectors, and I offset it with a bond and fixed income portfolio based on a growth or an aggressive portfolio with a 70% split to equities and a 30% split to fixed income. I call this the diversified growth portfolio. Now, it is illustrated with the green line here and is being contrasted with various other portfolios that are not diversified, that are just focused in one particular industry or sector. That would be the healthcare, material sector, communications, and financials. Now, I will say the diversified portfolio has each of these sectors in it, along with the S&P 500, as well as the fixed income portfolio that I spoke about, with about 20% being in U.S. Treasuries and 10% into a total bond market index fund. So without further ado, I'm going to go right to the line and show you how each has done. I'll do that by scrolling down just a little bit to show you the comparison from the beginning of 2008 until the end of 2020. Now, each portfolio started off with $10,000. Here's the ending value showing what the value is at the end of the 13-year time frame. So our diversified growth portfolio, again with a 70-30 split, and the diversification on the equity side between various industries, has basically tripled. The return is over 200%. We can see that our healthcare only portfolio has been the best performer out of any sector, and it's done a little bit better than our diversified portfolio, but not by much. It's tripled as well. We have our materials only portfolio that is more than doubled, as has our communications only portfolio. Our financial portfolio is lagging, but it's nearly doubled over 13 years. Now, what we see is that by building a diversified portfolio, we've been able to maximize our gains and stay up to speed with our best performing sector without having to compromise by taking on any unnecessary risk. And I'll scroll down a little bit so you can see what I'm talking about as far as risk is concerned. Now, this particular section of our chart shows each year's performance. The cumulative return shows the percentage that is going up or down in a given year. Now, our worst year over the 13-year time frame in our diversified portfolio was 2008, as expected. The housing bubble, the financial crisis, basically financial Armageddon took place in 2008 and early 2009. The S&P 500, which is what people refer to as the market, typically was down nearly 38, we'll round up 40%. Well, our portfolio was only down 16%. Pretty much every other calendar year, with the exception of 2018, it has had positive returns with about an 8% decline in 2018. So from a fluctuation standpoint, as compared to the market, it is a lot less volatile, which is what you want your portfolio to do. You want to minimize the volatility while still being able to take advantage of those growth opportunities. And that diversified portfolio over this time period has been able to do that. Now, we contrast that with the various other portfolios. We'll see that some of them hadn't fared quite as well. I'll start with our best overall performer, the healthcare only portfolio. As you can see, its worst year was also 2008, but it did slightly worse in 2008, meaning there was more of a valley, so more fluctuation, more volatility. Even though over time it performed better, we want to minimize the volatility throughout the time frame. That way, if something occurs where you have to get to your money, you don't have to worry about it being down too significantly at any specific point in time. Um, to keep on going, we look at the materials only portfolio. 2008 was a rough year. It was down nearly half, 46% that year. Imagine if you had all of your eggs in this one basket. The same can be said for the communications only portfolio, and a lot of people are thinking, "Oh man, I want the communications. We're doing everything digitally now. We're connecting digitally." Well, look what would have happened in 2008, down 38%. Again, putting all of your eggs in one basket is very risky. It pays to diversify. Again, I wanted to give you some social proof to prove that implementing the strategies we talked about can benefit your portfolio. You'll still make money, good money at that, and you'll minimize the risk you're taking along the way. Thank you.